how to apply and get approved for a Kentucky mortgage loan.
All right, let's talk about buying a home. It's one of the biggest moves you'll ever make, right? In this explainer, we're going to crack the code on the whole mortgage approval process, specifically for us here in Kentucky. We'll turn that complicated stuff into something simple so you can walk away feeling confident. So you're dreaming of that perfect home in the bluegrass state, but then the thought of mortgage paperwork and applications just makes your head spin? Yeah, you are definitely not alone. It's this crazy mix of excitement and anxiety, but I promise you, it's way more manageable than you think. Okay, let's dive in. We can break this entire process down into just 4 simple parts. I want you to think of them as the 4 pillars that hold up your mortgage approval. If you understand these, you pretty much understand the whole game. And here they are, the big 4. Your income, your assets, your credit, and the appraisal of the property itself. Every single lender, I mean every single one, is going to look at these 4 things. So let's tackle them one by one, starting with income.
So, pillar number 1, income. What exactly do lenders consider good income? Well, it really boils down to one word: stability. They want to see a solid, provable 2-year track record. And they need to feel pretty sure that your income isn't just going to disappear, that it's likely to continue for at least the next 3 years. This just proves to them that you can handle that mortgage payment month after month.
So how do lenders actually figure out what you can afford? Well, they use these 2 key numbers, or ratios. First up, you've got the housing ratio. The goal here is for your total house payment, that's principal, interest, taxes, and insurance, to be under 33% of your gross monthly pay. Then there's the debt ratio. This is your house payment plus all your other monthly debts, like car payments or student loans. You want to keep that total under 45% of your gross income. If you're in that zone, you are looking golden. Okay, let's move on to our second pillar, your assets. Now, this is the money you have saved up, in your checking, savings, 401k, that kind of thing. Lenders look at this for 2 main reasons. First, obviously, to make sure you have the down payment. But second, and this is important, they want to see that you'll have a little cushion left over, some reserves for when life throws you a curveball after you move in. So how much do you really need for that down payment? It actually varies a lot. Some amazing programs like USDA and VA loans can literally be 0% down. Then you have FHA loans, which are super popular, and they start at just 3.5%. Conventional loans, usually between 3 and 5%. The big takeaway here is you don't always need 20% down. There are options for almost every budget. All right, time for our third pillar, credit. This is a big one, and it comes with a question I get all the time. You technically have 3 different credit scores from the 3 main bureaus, TransUnion, Equifax, and Experian. But when you apply for a mortgage, which one does the lender actually use to make their decision?
Let's just look at a quick example. Say your scores are a 590, a 679, and a 618. I mean, they're all over the map. So which one becomes your official qualifying score?
It's the 618. Lenders don't average your scores. They don't pick the highest. And thank goodness, they don't pick the lowest. They always use your middle score. Just knowing that one simple rule is a huge piece of the puzzle. It tells you exactly where you stand.
And that score, it really matters. A 580 can get you in the door for an FHA loan, which is awesome. Once you hit 620, a lot more loan programs and options open up to you. But when you get to that 720 mark, oh yeah, that's when lenders start seeing you as a really solid applicant. And 760, well, that's the sweet spot. That's where you're going to get offered the absolute best interest rates and terms.
Finally, our 4th pillar, the appraisal. This is simply when a professional comes out to confirm the home's value. The bank needs to know that the house is actually worth the money you're borrowing. And here's the critical rule you have to remember. The official value for the loan is always the lower of the sales price or the appraised value. This protects you and it protects the bank. Okay, so now that we know what lenders are looking for, those 4 pillars, let's check out the tools that can help you meet those requirements. These are some of the most popular and most powerful loan programs available right here for us Kentucky homebuyers. This little chart breaks down the heavy hitters. A conventional loan is often great for people with stronger credit, especially because you can eventually get rid of the mortgage insurance. An FHA loan is a real go-to for many first-time buyers because it's more flexible on credit. A VA loan is just a fantastic, earned benefit for our veterans and service members. And a USDA loan? It's perfect if you're looking to buy in one of Kentucky's eligible rural areas. Let's dig into that a little more because for a lot of people, this is the most exciting part. The whole idea of buying a home with no money down might sound too good to be true, but here in Kentucky, it is absolutely possible. So, there are three main ways you can get into a home with 100% financing. We've got VA loans for our veterans, we have USDA loans for homes in designated rural areas, and then there's the Kentucky Housing Corporation, or KHC. They offer some really powerful down payment assistance programs. And we're not talking about a small amount of help either. Right now, the Kentucky Housing Corporation offers up to $10,000 in down payment assistance. For so many first-time homebuyers, that's enough to cover the entire down payment and maybe even some of the closing costs. It's a real game changer.
Now, if you've had some credit bumps in the road in the past, please don't get discouraged. It doesn't mean you can never buy a home. It just means you need a plan. There are required waiting periods, as you can see here. After a bankruptcy, you're usually looking at 2 to 4 years. And after foreclosure, it could be 2 to 7 years before you can qualify again.
Whew, okay, we have covered a ton of ground. So let's pull all of this together into a clear blueprint, your own personal action plan to get you started on the path to owning that home in Kentucky. Here are the most important takeaways. First, figure out your 2 income ratios. Second, pull your credit and find that all-important middle score. Third, see if you might qualify for one of those zero-down programs. And hey, look into the rules for using gift money for a down payment. And always ask lenders about their specific requirements, because they can be a little different from place to place. And just one last thing, please remember that this explainer is a guide to get you started. It's not a guarantee of approval. Everybody's situation is unique, so your absolute best next step is to talk with a loan officer who can look at your specific circumstances. So there you have it. We've laid out the map. We've given you the blueprint. This whole process isn't a mystery anymore. The only question left is the one right there on the screen. What is your first step? Thanks for tuning in.